Some alarming observations have been coming to life in recent weeks. The Federal Reserve Bank of San Francisco has observed a rapid depletion of excess savings among Americans, and this paints a very interesting picture for the U.S. economy. Now, excess savings, which denote the disparity between actual savings and the savings trends prior to the recession, have been a safety net for many households. And by June, this buffer had shrunk to less than $190 billion, which is a stark contrast from the record $2.1 trillion in 2021. Now, this massive accumulation in 2021 was largely due to government stimulus checks and a pandemic-induced decrease in personal spending. Researchers from San Francisco Fed have voiced their concerns about future economic landscape, and their projections indicate a potential complete depletion of these excess savings by the end of Q3 2023. That's this year. Now, this is not an isolated observation. Multiple indicators suggest that U.S. households are on the brink of exhausting the financial cushion they've built since the pandemic's beginning. The consistent monthly decline of excess household savings over the past 23 months is evidence to this trend. Government data further underscores the gravity of the situation, as it reveals an unsettling pattern of consumers consistently spending beyond their means, particularly evident in the last quarter of 2022 and the first quarter of 2023. Now, adjustments by the Bureau of Economic Analysis show a more strained economic scenario, with household disposable income being lower than anticipated. By July of 2023, this trend continued, with U.S. personal savings rates dropping to 3.5%, a figure below pre-pandemic averages. This rate is a reflection of the percentage of individuals' post-tax incomes after accounting for consumption. The ramifications of such a savings drought are about to manifest. Analysts predict a potential slump in consumer spending, especially as disposable cash reserves diminish and financial obligations like student loan payments resume in October. JP Morgan's Marko Kolanovic offers a bleak outlook, indicating that when adjusted for inflation, the excess savings for U.S. households, which peaked at $2.1 trillion in 2021, are now completely exhausted. This poses a risk of economic imbalance, and if spending continues to outpace savings, we're going to be in big trouble. Historically, Americans have relied on their savings to maintain consumer spending, especially after COVID-19 restrictions. This consumer behavior played a pivotal role in hedging the economy, even in the face of Federal Reserve's aggressive interest rate hikes since last spring. However, the rate of inflation, which soared since mid-2021, has now completely gnawed away at these savings, with prices skyrocketing in sectors like energy and food. Households have definitely felt this pinch. Now, although inflation did peak at a staggering 40-year high at 9.1% in mid-2022, recent measures by the Feds have managed to rein it in to about 3% on the previous month. Now, the rapid depletion of excess savings, coupled with external economic pressures, press significant challenges for the U.S. economy in coming months. It will also be a test of the average American household resilience in the near future. But what else could this mean? Well, the central bank, like the Federal Reserve in the U.S., use interest rates as a tool to either stimulate the economy or cool it down. And if depletion of savings threatens consumer spending, a major component of economic growth, the central bank might be inclined to lower interest rates. This would make borrowing cheaper, encouraging consumers and businesses to take loans, therefore stimulating spending and investments. So, will the Feds act or react soon enough? Will they tame inflation while also helping the American savings accounts? Well, we're going to have to wait and see. Until next time, stay sharp, Market Pulse members, and stay tuned by subscribing or smashing that like button. Thanks.